If you own a business and you're paying 30, 40, or even 50% in taxes, Puerto Rico's Act 60 Export Services Decree may be the most important thing you watch this year. We're talking about a 4% corporate tax rate, 0% on dividends paid to yourself as a resident, and complete exemption on capital gains accumulated after you move. All completely legal. All available to U.S. citizens. And almost nobody in the mainland business world is talking about it seriously. Today, we're going deep. This is the full business owner's guide to Puerto Rico's Act 60 Export Services Incentive. What it is, who qualifies, exactly what the tax benefits are, what it costs to set up and maintain, what the government actually requires from you, and whether this makes financial sense for your specific situation. Let's start at the beginning. Puerto Rico is a U.S. territory. That means you do not give up your U.S. citizenship. You do not expatriate. You do not renounce anything. You are still an American citizen with an American passport, living in an American territory, subject to U.S. federal law. But because Puerto Rico has a unique relationship with the federal government, it has the authority to create its own tax system for income that is sourced within Puerto Rico. That is the foundation of everything we're talking about today. Act 60 is an umbrella tax incentive law that Puerto Rico passed in 2019. It consolidated several older laws, including what was previously known as Act 20 for businesses and Act 22 for individual investors, into a single code. The business side of Act 60, specifically Chapter 3, which covers export services, is what we're focused on today. The core concept is straightforward. If you have a business that provides services to clients outside of Puerto Rico, and you move that business to Puerto Rico, your corporate income tax rate drops to 4%. For context, the federal corporate tax rate in the U.S. is 21%. Most states add another 5 to 12% on top of that. So you could be paying 30+% today and drop to 4% by relocating your business to Puerto Rico. Let's talk about what types of businesses qualify, because this is where a lot of people get confused. The key requirement under Act 60 Export Services is that your business must provide services to markets outside of Puerto Rico. The services must be exported, meaning your customers or clients are not Puerto Rican residents. This is the critical test. Businesses that commonly qualify include software development companies, technology services firms, consulting businesses of virtually any kind, marketing agencies, design and creative agencies, financial services including investment advisory and fund management, legal services where the clients are outside Puerto Rico, medical and health services provided to patients outside the island, research and development operations, and call centers serving external markets. The key question to ask about your business is this: are my clients and customers located outside of Puerto Rico? If yes, your business activity is likely eligible. If your business primarily serves Puerto Rican residents, it does not qualify for the Export Services Incentive. One important nuance: even if you currently have some local Puerto Rican clients, that doesn't necessarily disqualify you. The business just needs to primarily serve external markets. You can still have a small percentage of Puerto Rican revenue without losing the incentive, though you'll want to work with a Puerto Rico tax attorney to structure this correctly. Now, let's go through the exact tax benefits because the numbers are significant. First, your Puerto Rico sourced business income is taxed at 4%. This applies to net income earned by the business from the qualifying export services. On $1 million of net profit, your Puerto Rico corporate tax is $40,000. Compare that to a California-based corporation where you might pay 21%, federal plus 8.84% California corporate tax. That's nearly $300,000 on the same million in profit. The difference is $260,000 per year. Second, dividends you receive from your Act 60 business are exempt from Puerto Rico income tax. When you pay yourself from your business as a bona fide Puerto Rico resident, those distributions are not taxed at the personal level in Puerto Rico. This is distinct from the mainland, where qualified dividends are taxed at 15 to 20% federally plus state taxes. Third, capital gains on assets you acquire after becoming a Puerto Rico resident are completely exempt from Puerto Rico taxes. If your business appreciates in value and you eventually sell it, the gain is not taxable in Puerto Rico. This is potentially the most significant benefit of all for business owners building toward an exit. Fourth, there is a property tax exemption on real and personal property used for your qualifying business activity. And there is a municipal license tax exemption as well. Let me now walk you through exactly what it takes to qualify and set this up, because there are real requirements and they matter. Step 1 is establishing bona fide residency in Puerto Rico. This is required, not optional. You personally must become a bona fide resident of Puerto Rico under IRS rules. This means you must spend more days in Puerto Rico than in any other single state during the tax year. The IRS uses a presence test, and the general guidance is a minimum of 183 days in Puerto Rico. You must also establish Puerto Rico as your tax home, meaning your primary business connections and personal ties are in Puerto Rico. This is not a mailbox situation. You cannot keep living in New York or California and just pretend to be in Puerto Rico. The IRS actively scrutinizes Act 60 participants. You must genuinely relocate. That means having a real residence in Puerto Rico, and that's either owned or rented where you actually live. Step 2 is applying for your Act 60 Export Services Decree. This is done through Puerto Rico's Department of Economic Development and Commerce, known as DDEC. You submit an application, pay an application fee of $750, and describe your business and its qualifying activities. The review process typically takes 2 to 4 months. Once approved, you receive a tax decree, a legal contract between you and the Puerto Rican government guaranteeing your tax rates for 20 years. That 20-year guarantee is significant. It gives you long-term certainty that the tax treatment will not change for your business, even if Puerto Rico later modifies its incentive laws. Step 3 is setting up your Puerto Rico business entity. You will need a Puerto Rico corporation, or LLC, operating out of Puerto Rico. This entity is what conducts the qualifying services and earns the income subject to the 4% rate. You'll need a local registered agent, local business filings, and proper accounting to segregate Puerto Rico source income from any U.S. source income. Step 4 is establishing real economic substance in Puerto Rico. This is where many people make mistakes. Puerto Rico and the IRS expect to see genuine business operations on the island, not just a shell entity. You need to have a real office or work location in Puerto Rico. You need to have at least one full-time employee employed in Puerto Rico who is a bona fide resident of the island. This can be you if you're working from Puerto Rico yourself, but you need to be genuinely operating there. You must also pay an annual report fee and a minimum charitable contribution of $10,000 to a Puerto Rican nonprofit as part of maintaining your decree. Step 5 is the annual compliance requirements. Every year, you must file an annual report with DDEC confirming that you are still meeting the decree requirements. You must file Puerto Rico corporate tax returns. If you had U.S. source income from clients in the mainland, that income remains subject to U.S. federal taxes. Only Puerto Rico source income gets the 4% rate. This means your bookkeeping needs to carefully track the source of every dollar your business earns. Let me address the cost question directly, because this is something most content creators gloss over. There are setup costs. Your Act 60 application fee is $750. You'll need a Puerto Rico attorney to help with the decree application and business setup. Expect to spend between $2,000 and $5,000 depending on the complexity. You'll need a CPA familiar with Puerto Rico tax law, and ongoing accounting fees tend to run $1,000 to $2,000 more per month than mainland accounting due to the dual filing requirements. There are relocation costs. You are moving your life and your business to Puerto Rico. Housing in Metro San Juan generally less expensive than major mainland cities. But you need to factor in moving costs, possibly maintaining relationships in your former city for a transition period, and the lifestyle changes involved. There is the $10,000 annual charitable contribution requirement. Though this supports Puerto Rican nonprofits, and many Act 60 participants find organizations they genuinely want to support. There is also a real cost to spending at least 183 days in Puerto Rico. If your clients are in New York or Los Angeles, and you need to be in those cities frequently, you'll have ongoing travel costs that you don't currently have. So who does this actually make sense for? The math starts becoming very compelling when your business earns above $200,000 in annual net profit. At that level, even accounting for the setup, relocation, and compliance costs, the tax savings are substantial. At $500,000 in net profit, you could be saving over $100,000 per year in taxes. At $1 million in net profit, $200,000 or more per year. For businesses earning under $100,000 net, the overhead of compliance, dual accounting, relocation, and lifestyle disruption may eat up most of the benefit. It's not impossible that it still makes sense, but the analysis is closer. The ideal Act 60 business owner is someone who already operates a location-independent business, consultants, software developers, digital marketers, fund managers, remote service firms. If your business requires you to be physically present in a specific U.S. city every day, Act 60 is much harder to execute properly. Now, let's address the risks and the things that can go wrong. The IRS does audit Act 60 participants. There have been documented cases of people claiming Act 60 benefits while continuing to live primarily on the mainland. The IRS has flagged these situations and assessed back taxes, penalties, and interest. The risk of trying to fake the residency requirement is not worth taking. If you're going to do this, do it genuinely. There is also political risk. Act 60 comes with a 20-year decree guarantee, but there has been ongoing debate in the U.S. Congress about whether Puerto Rico's tax incentives are appropriate. There is no guarantee that future federal legislation won't change the treatment of Act 60 income. Most tax attorneys consider this a low to moderate risk over a 20-year period, but it is a real consideration. Puerto Rico also has some real infrastructure challenges. Power outages, internet reliability, and local bureaucracy can be frustrations. Many Act 60 participants use generators and satellite internet. San Juan's Condado and Dorado areas have modern infrastructure that significantly reduces these issues. Here's my honest take on who this is really for. If you own a profitable service business, you are location independent, or can become so. You are serious about building wealth and willing to actually relocate your life. And you have the discipline to maintain proper compliance. Act 60 is one of the most powerful legal tax strategies available to American entrepreneurs today. The combination of 4% corporate tax, 0 on dividends, and 0 capital gains on appreciation is genuinely extraordinary compared to anything available in the 50 states. If you're looking for a shortcut that lets you keep living in your current city without actually moving, this is not that. The IRS will catch you. The penalties are severe, and it's not worth the risk. Get serious legal and accounting counsel from professionals who specialize in Puerto Rico tax law. The savings are real. The requirements are real. Do it right or don't do it at all. If you found this breakdown valuable, subscribe to Fuel Your Wealth. We cover tax strategy, wealth building, and the financial moves that actually change your trajectory. Hit like if this helped clarify Act 60 for your business. This is not financial or legal advice. Always consult with a qualified tax attorney and CPA before making decisions of this magnitude. Puerto Rico tax law is complex, and your specific situation matters.